Hello and welcome. In this video, we will learn about mark to market adjustment. Alright, basically, what we will be learning is how margin is adjusted on a day to day basis. Okay, now first I will go to my Zerodha dashboard and show you few things and then come back to the presentation and continue with the lesson. Alright. Alright. So I'm in my Zerodha dashboard and here you can see I've added Infosys April, May and June futures. And when I click on buy button, you can see that it says this much money is required to buy one lot of Infosys futures. Okay, so this much money is required to buy the Infosys futures. Alright, so now let me cancel this. Let us say that we want to sell. Okay, so I'll move the mouse over here and click on sell button and let me move this up, and you can see it says that I need this much money to sell the futures to. Okay, so here you can see if I click on sell, you can see that this is the amount that I need to sell the futures. Okay, so this is the margin amount needed. Now let me take this and go back to my presentation. Now, when you consider a shop, a physical shop, you have a buyer and a seller. Seller is the shopkeeper, correct? Now, when you buy the product, any product from a shop, you physically receive the product. That means you can feel the product in your hands. And in the same way, when you buy a product, you pay the money to the shopkeeper or the seller. And the shopkeeper or seller can physically feel the money in his hands, or he receives the money physically, correct? This is how a transaction works. The same is true for buying or selling shares too. In a share market, stock market, you buy and sell shares, correct? When a buyer buys the stocks or shares, he receives it in his demat account. So he can see how many shares are there and of what company. He can hold it for a very long time. And the person who has sold shares to this buyer is the seller, and he receives money in his account, correct? He receives money when the buyer buys stocks from him. He receives it. It is reflected in his account, correct? But when we come to derivatives, meaning futures and options, we do not trade any physical item here. No physical item is exchanged in the transaction. Only promise or word is bought and sold, correct? So buyer buys the promise, seller sells the promise, and that's all. You cannot feel anything in your hands. Nothing is reflected over a long period of time. So, what is the guarantee that the person who is in loss will pay to the person who is in profit? There is no guarantee, correct? So, let us say this person is the buyer of a future, this person is the seller of a future. And let us say buyer is in profit. What is the guarantee that the seller will give the profit to the buyer? He can just say that I am not willing to give you the profit. I do not want to continue this trade anymore and stop. What is the guarantee? The guarantee is the margin. So margin is the guarantee. that the person who is in loss pays to the person who is in profit. Okay. Now, a question may come to your mind. Why should seller pay the margin money too? When you want to buy something, you have to pay. It makes sense. But when you want to sell something too, why do you have to pay? This is because when a buyer and a seller enter into a contract, they do not know who will be profited from the contract. If you are the buyer and I am the seller, and if you and I enter into the contract, we do not know whether you will be in profit or I will be in profit when we close the contract. Correct? We are just guessing. You, the buyer, you guess or predict that the price will go up. I am the seller and I predict or guess that the price will go down. Both may be correct, both may be wrong. Okay? In the sense, you may be right, I may be wrong, or I may be right, you may be wrong. So there are chances, and we do not know who will be in the profit. And so even the seller has to pay the margin money. Okay? Even the seller has to pay the margin money. Next, where does the margin money go? To whom are you paying this margin money? You are not paying this to anyone. This money goes nowhere. It is just blocked in your account. Which account? Trading account. Okay? So when you buy or sell a future, the money does not go anywhere. It is not paid to anyone. It is just blocked in your account. Okay? Next question. When is the margin money used? The margin money is used when the buyer or seller is in loss. Okay? I am keeping everything simple here. Alright? So when the buyer or seller is in loss, the margin money will be utilized. This is why every day the margin money must be maintained in the account. There are much more concept to this which I do not want to explain and confuse you right now. Alright, but just know that margin money should be maintained daily in the account. Alright, so I am going to explain this with an example. Now, let us say the date is April 6, 2023. Okay, we have a buyer and we have a seller. And let us say the buyer and the seller decide about Tata Motors. Okay, decide about Tata Motors. Buyer guesses that the price will go up, seller guesses that the price will go down. Okay, now they enter into a contract and let us see what contract it is. They enter into a contract which expires in May. So this is April and the contract that they enter to is May. So last Thursday of May, the contract will expire. Okay. So you can do that. Even if you are in April, you can buy April futures or May futures or June future. Okay. Now, they decide to buy May future. The lot that they decide upon to buy is 1. Okay. They buy one lot and the size of one lot is 1000. Meaning, one lot of Tata Motors has 1000 stocks of Tata Motors. Okay, or I can say one lot of Tata Motors future has 1000 Tata Motor stocks. Okay. Next, the price as on the date of buying, which is April 6th, is rupees 5. Okay. So on April 6th, let us say at 10 a.m. Okay, 10 a.m. in the morning, the price is 5. Meaning, if you want to buy one stock of Tata Motors, you have to pay 5 rupees. Okay, this is small number. This is not real number at which Tata Motors is trading. I've taken small number so that the calculation will be simple for you. Okay. So at 10 a.m. Tata Motors is trading at rupees 5, and that is when these two enter into a contract. So how much should they pay in reality? It is 5 into 1000. 5 into 1000 rupees 5000. So this is what they need to pay in reality. But as you know, you don't have to pay full amount when you are buying futures or selling futures. You just have to pay margin money, margin amount. Let us say that the margin required is 20%. Okay. This margin depends on the volatility of the stock. If the volatility of the stock is more, then it will be more. If it is less, then it will be less. Alright. Now, while entering the trade, let us say the margin required is 20%. After that, we will assume that the margin increases to 25%. Alright. Now, 20% of 5000 rupees is 1000 rupees. So, the buyer has to pay 1000 rupees margin to buy one lot of Tata Motors shares, which is future. Okay. And the seller also has to pay 1000 rupees to sell one lot of Tata Motors shares, which is nothing but futures. Alright. So let us assume that both buyer and seller enter into a trade by paying the margin money. Okay. Yes. Now let us proceed and see a little bit of calculation. Okay. So these are the parameters. These are the parameters which I explained just now. And let us say that they enter into the trade at 10 a.m. on April 6th. Okay. On the left side we have buyer's account, and on the right we have seller's account. Account balance before entering into the contract is 5000 rupees of the buyer. Okay. So before entering into the contract, this is how much the buyer has in his account. And the same amount, rupees 5000, is what the seller also has in his account before entering into the contract. Okay. Now, we have calculated that this is the amount that both have to pay to enter into the contract. So once they enter into the contract, this is how much is left in the account of buyer. Okay. So 5000 minus 1000 is 4000. So this is the account balance of buyer. What account balance? The trading account balance. The amount that is in the trading account of the buyer. Same goes to the seller. 4000 rupees is in the account of seller. So 1000 is paid as margin, 1000 is paid as margin while buying, while selling. Okay. I hope you remember this. You can pause this video and take a note of it in a book so that you can follow along with the calculations and understand the concept better. Okay. Now this is on April 6th. On April 6th at 10 a.m. the buyer and the seller entered into a trade, and after 10 a.m. the price moved up and down, and when the market closed the price was 6 rupees. Okay. In India the market for retail traders closes at 3:30 p.m. and let us say that at 3:30 p.m. the price of the stock was rupees 6. Alright. Now let us say that the margin has increased to 25%. Initially, when entering into the trade, it was 20%. Now let us say that the new margin requirement is 25%. From now onwards, we will assume that the margin remains 25%. Alright. So now we'll see how much does the buyer make or how much does the seller lose. Okay. Account balance is 4,000 rupees. Okay, account balance is 4,000 rupees. Intraday profit. Intraday meaning on that particular day, on the very day, same day. Okay. Intraday profit is 6 into 1000 minus 5 into 1000, which is 1000 rupees. Alright. Now, how is this? The closing price is 6, lot size is 1000. Okay, 6 into 1000, 6000 minus 5. What is 5? 5 is the amount at which the buyer bought the lot. So 5 into 1000. So the buyer bought the lot at 5. He did not pay 5,000 rupees. He paid only the margin. Okay, he paid only the margin. But this is how we calculate the profit and loss. Alright. So 6,000 minus 5,000 is 1,000 rupees profit. Okay. Now to the seller side. Account balance is 4,000 rupees. Intraday loss. 5 into 1000 minus 6 into 1000, which is 1000. Now you must remember that whatever is gained by the buyer will be lost by the seller. Okay. So this will be equal. Alright. So rupees 1000, rupees 1000. This will be equal. Whatever the buyer gains, the seller loses for the same lot. Okay. It is for the same lot. Now, see how is this once again? 5 into 1000 at which the seller sold it. Now 6 into 1000, 6000. So 5000 minus 6000 is 1000 rupees. Okay. Now, the new margin required is this much. So try to understand this concept. New margin required is this. How is this? See, 6 rupees is the closing price into lot 6,000 rupees. 6,000 rupees is required to buy 1000 stocks of Tata Motors. Correct? But when you come to futures, you just have to pay margin. And margin is 25% here. So 6 into 1000 into 0.25. So rupees 1500 is required if you want to buy the Tata Motors future. Okay. So if you had bought at 10 a.m., then only 1000 was enough. Now it has closed, but let us say if the market was open and if you wanted to buy the future, then you should have paid 1500 rupees. Okay. Now, see, when we say new margin, this must be maintained same in the account. Okay. This must be maintained same in the account. How much margin was paid at 10 a.m.? It was 1000 rupees. Now how much is required? 1500 rupees. Meaning extra 500 rupees must be paid by the buyer to maintain this. Okay, try to understand. Extra 500 rupees must be paid by the buyer to maintain this margin. Clear? I'll come back to this. Same goes to the seller. The current price is 6, and if the seller wants to sell now, let us say the market is open and it is trading at 6 rupees. If he wants to sell now, then he should pay 1500 rupees, correct? 1500 rupees. So now what he has to do is maintain this amount in his account, or I can say he has to pay extra 500 rupees margin money. All right, he has to pay extra 500 to as margin money. To whom? To the broker. Okay, to the broker. So he is the one that maintains the margin in your account. Okay. Now I'm going to keep the calculation simple. All right, so that you understand the concept. Now, when I say the buyer is in profit of 1000 rupees, where will this money come from? This money comes from the margin amount of seller. Okay, when we say buyer is in profit, from where do we give him the profit? From where do we give him the money? From the seller's margin. Okay, from the seller's margin. And so the seller has to maintain this amount. Seller has to maintain this amount. Now, if you are a beginner, this calculation may look confusing to you. So once again, instead of confusing you more, I am going to explain you simple way of calculating this. Okay. Next account balance after margin adjustment is 4500. How did I get this? See, account balance at 10 a.m. was 4000 rupees. At the end of the day, the buyer was in 1000 rupees profit. Okay, and the new margin required according to new calculation is 1500 rupees, meaning he has to pay extra 500 rupees to maintain this margin. So now see how this calculation can be done. You can think of it in two ways. Account balance 4000 plus profit 5000. Okay, 4000 plus 1000, 5000. 5000 is what the buyer has now, but he has to pay 500 rupees for the margin. So 5000 minus 500 is 4500. So account balance after margin adjustment is 4500 rupees. Okay. Now you can think of it like the way I explained, or think of this in one more way. So profit is 1000 rupees. Out of this profit, he has to maintain the new margin. So out of 1000 rupees, he pays 500 rupees for the margin. So 500 rupees remains, and the 500 is added to the account balance. What can you do with the account balance? You can buy a different future of different company. You can withdraw it too. Alright, but generally we do not do that because there are much more thing to it. Okay, once again, I do not want to confuse you much, but after paying the margin, this is what is in the account of buyer. Okay, this is what is in account of buyer. Now coming to seller's account, the seller had 4000 rupees as account balance. He was in loss of 1000 rupees. Then again he need to pay 500 rupees margin money. So now think of the calculation like this: 4000 minus 1000. Why minus? Because he is in loss. So 3000 rupees. From that 3000 rupees, he need to pay 500 margin money. So account balance after margin adjustment will be 2500 rupees. Okay, 2500 rupees. Okay, so I hope this is clear. Now where will this margin money go? It will not go anywhere. It will be blocked in your account. That's all. So whenever you square off or whenever you close the trade, this will be given back to you. Okay, this will be given back to you. Now think of this as the security deposit that you pay at various places. You pay some amount at banks too, correct? As security deposit. Or if you are at a let us say a mall where you have to get something, they will ask you security deposit. Not in a mall, that was a very bad example, but various places they take security deposit which will be given back to you when you go back, correct? So this is nothing but the security deposit. This will be given back to you. Alright. Now, if the buyer closes his position at 6, let us say that before the market close, when the price came to 6, okay, let us say that the price was 6 rupees at 2 p.m. okay, market closes at 3:30 and let us say it was 6 rupees at 2 p.m. alright. If the buyer decides that 1000 profit is enough for him, he will close the trade, then he will get this one plus this one in his account. Account balance is 4500, correct? He will get the margin money back. So 4500 plus 1500, 6000 rupees in his account if he closes, okay, if he comes out of the trade. So how much was in the account? Initially it was 5000, correct, before buying the future. After closing the position it is 6000, so total profit is 1000 rupees. Okay, same goes to the seller. If the seller closes his position at 6, if the seller decides that, oh, this is too much of a loss to me, I will come out of the trade, and if he does that, this plus this is what he gets in his account. That is 4000 rupees. Account balance is this. This, as I said, is security deposit which he gets back when he closes the trade. So 4000 rupees. How much was it before entering the trade? 5000. Now it is 4000, so total loss is 1000 rupees. Clear? Okay. So this is for the first day. Now, let us say that both buyer and seller decide to hold their position for the next day or carry over their position for the next day. Or in other words, they do not close at 6 and 6. The buyer thinks that, okay, so I have made 1000 profit. I may make more tomorrow, so let me hold it for the next day. So this is what buyer thinks. The seller may think that, oh, I'm in 1000 rupees loss, so I do not want to come out of this loss now. So let me hold it for one more day and see if the price goes down. So that is what the seller thinks. And both do not close their position at 6 and hold it for the next day. Okay. Let us go to the second day. Now this is April 6th. April 7th, market close. Okay. On April 7th, the price has moved up and down and it has closed at 7 rupees. Okay. It has closed at 7 rupees. Now let us calculate the details. Margin is still 25. Account balance is 4500. This is from the previous day. Okay. This is from the previous day. Intraday profit is 1000 rupees, meaning the amount that he has earned in that particular day is 1000. Okay. On 7th, how much is the profit? That is this. So how did I get this? It has closed at 7. 7 into 1000. 6 into 1000 was the previous day's price. So 6 into 1000. 7000 minus 6000 is 1000 rupees. This is the amount that he has earned in that day on 7th. Previous day it was 1000. Today it is 1000. Okay, so we are calculating intraday. I am keeping everything simple. Alright. Account balance of seller was 2500 rupees. This is from previous day. Intraday loss is once again 1000 rupees. So what he gains is what he loses. Okay. Now the margin requirement is 7 into 1000 into 0.25, which is 1750. Okay. Same goes for seller. So this much money must be maintained as margin. This much money must be maintained as margin. So now let us calculate. 4,500 plus 1,000 is 5,500. Okay. From 5,500, he needs to pay how much? 250 rupees. Why 250 rupees? Because previous margin was 1,500 rupees. Okay. On April 6th, the margin was 1,500 rupees. Now it is 1,750. So 250 more is needed to maintain this. So 5,500 minus 250 comes to 5,250. So this will be the account balance after margin adjustment. Alright. Coming to this. 2,500 is account balance. He is in a loss of 1,000 rupees. So 2,500 minus 1,000 is 1,500. From that 250 must be given for margin, and so account balance after margin adjustment is 1,250 rupees. So this is what he can see in his account balance. Okay, and this adjustment of margin on a day-to-day basis is called as mark to market adjustment. Okay, now if the buyer closes his position at 7 rupees, okay, if the buyer decides that okay, so this much profit is enough for me, I will close the trade, then he will get this plus this in his account, which is 7,000 rupees. So how much was it before? 5,000. How much is it now? 7,000. So totally 2,000 rupees profit he has made in this trade. Similarly, if the seller decides to close his position at 7, if the seller thinks that oh, this is too much of a loss to me, I want to come out of this trade, then he will get this plus this, which is 3,000 rupees in his account. Okay, it was 5,000, now it is 3,000, and it is a loss of 2,000 rupees. Clear? Okay, that is if the buyer closes, if the seller closes. Now let us say that they do not close it, and carry it to next day too. Let us say that the buyer thinks that the price will still go up, and the seller thinks that this is too much of a loss, let me hold it for one more day and see whether the price will go down. And if they hold it for next day, then on next day, let us say that price comes to 1 rupees. Okay, it was 7, but then let us say there is a bad news, and so the price came to 1 rupees. The margin still is 25%. This does not change. Okay, this does not change. Now let us calculate the buyer and seller's profit. The account balance from the previous day is 5,250 rupees. Intraday loss now is 6,000 rupees. Okay, intraday loss is 6,000 rupees. And coming to account balance of seller, it is 1,250 rupees, and intraday profit is 6,000 rupees. This is his intraday profit, meaning on 8th he has made this much profit. On 8th this is his loss. Okay. Now the new margin is 1 into 1000 into 0.25. Why 1 into 1000? Because the price is 1000 now. Sorry, 1 rupees now. So 250 rupees. New margin for him also it is rupees 250 rupees. Okay. This is what must be maintained in the account as margin. Now, what was the previous day's margin? It was 1750 rupees. Correct? But now today only this much needs to be maintained. So how much extra is in margin? It is 1500. Correct? So 1500 rupees is extra which is in margin. So that will be given back. Okay, that will be given back. So after the margin adjustment, this is what will be in the account. See, 1500 will be given back from the margin, but then the person has a loss of 6000 rupees. So the loss minus this plus 1500 comes to 750. Okay, I'm going to repeat that again. 5250 plus 1500 margin. Okay, so that minus 6000 loss comes to 750 rupees. Now, coming to the seller side, the account balance after margin adjustment is this much. How is it so? This is the account balance from previous day. To this, add 1500 rupees margin money. Okay, that comes back. Okay, that comes back. So 1250 plus 1500 and then the profit. So add this too. So 6000 plus 1250 plus 1500 that has come back from margin gives you this much. Okay. So this is the account balance after margin adjustment. Now, on the third day, let us say that they decide to close the position. So the buyer closes his position at rupees 1. He has decided that he was not thinking proper, and so he waited for the third day, and then he had lost the 2000 rupees profit that he has made, and now he has gone to the loss, and so he decides to close his position, and so what he gets in his account is this plus this. Okay, which is 1000 rupees. Initially it was 5000 rupees, but now it is 1000 rupees. So total of 4000 rupees is the loss. Same goes to this person. So he decides that he has made a good decision of holding it for third day, and now it is in profit, and he decides to come out of the contract, and what he gets in his account is this plus this, which is 9000 rupees. Okay. Now what price did he enter? 5000. What is it now? 9000. So 4000 is the profit that the seller has made. Okay. So this is how margin is adjusted on a day-to-day basis. If more is required, then it is taken from the account. If more is not required, if it is in excess, then it will be paid back to the account. Okay. So that is why the account balance must be sufficient so that the margin can be paid properly or maintained same. Okay. Whenever you are not able to maintain the margin same due to insufficient balance in the account, then the broker will say that add funds to the account to maintain the margin, or else we will square off the position. What they are saying is add funds to account so that margin can be maintained. If you do not do that, then we will automatically close the position. You cannot hold it for next day. That is what they are saying. Okay. So I hope it is clear. I'll see you in the next video. If you have not understood the concept, go back and watch it once again. Okay.